Hello everyone. In this video, I will be talking about initial public offering. So initial public offering is the issuance of share first time by a company to general public. Okay, so when a company is registered as a company and become listed with the stock exchange, the company initiates to issue shares first time to general public, which is known as initial public offering. The next is underwriter. Underwriter plays an important role in initial public offering. So underwriter act as financial midwives to a new issue. Usually they play a triple role. First, they provide the company with procedural and financial advice. Then they buy the issue and then they resell it to general public. Now, to explain a little more, the underwriters have a different arrangement with the company. They start with the issuing company when a company decides that they will engage in IPO. So underwriter helps the company preparing all the paperwork for the IPOs, and they help them determining the share price. They help them selling them to the market, and for providing all these services, underwriter charge a price, or underwriter charge a cost that is known as underwriting fee. Now, sometimes it's known as underwriting a spread. Underwriting a spread is the difference between the public offer and the price paid by underwriter. So what essentially is, in a certain arrangement, underwriter may buy shares from the issuing company, let's say at $45, and then resell the shares to general investor at a relatively higher price, let's say $50. So this $5 will be the spread, which is also be considered as underwriting fee. Then prospectus. When a company decides that the company will go for an IPO, that means the company will issue shares to general investor, the company typically needs to prepare a document that is known as registration statement. This registration statement needs to be submitted to Securities and Exchange Commission. This statement is a detailed and somewhat cumbersome document that presents information about the proposed financing and the firm history, existing business, and plans for the future. And in this registration statement, the most important part that is distributed to investor is known as prospectus. Okay, so this prospectus basically include all the information required by an investor to make an investment decision. So you understand that when a company engages in IPO, it's an issue a prospectus. It's essentially inviting potential investor to invest in the company shares. So potential investors need all information about the company's past record, company's future potential, the risk associated with the company's management, their ability to run the business, and so on. So a prospectus will carry all this relevant information. And last of all is IPO underpricing. IPO underpricing is the notion that when a company engages in IPO and offer share to investors, this offer price is generally lower than what is suggested by the fundamental value. And the difference between the offer price and what supposed to be the fundamental value is known as IPO underpricing. We will discuss the IPO underpricing in a more detail shortly. Now, why a company engages in IPO? A survey was conducted to see the reasons or the motives behind the IPO among the CFOs, and you can see that there are various reasons the companies engage in IPO. So 59.4% of the CFOs responded that they engage in IPO to create public shares so that they can use them in future acquisitions. That means so that they can use these shares to acquire companies in future. About half of the CFOs responded that they engaged in IPO to establish a market value of the firm. You understand that if a company is privately held by its owners, it does not have an established market price or the market value, which can be obtained by engaging in IPO and selling shares in the market. And also, about half of the CFOs said that another motive for engaging in IPO is the enhanced reputation of the company. 46% said to broaden the base of the ownership, and 44% said that they engage in IPO because it allows one or more principals to diversify personal holdings. And few other motives are to minimize the cost of capital, to allow venture capitalists to cash out, to attract analyst attention. The company has run out of the private equity, and the debt capital becomes pretty much expensive. So you can see that there are various reasons a company engages in IPOs. Now, underwriting a spread, as I already mentioned, that the underwriters provide underwriting services to the company, and in one certain agreement they can buy the shares from the company and resell them to investors, which is known as underwriting fee. And that's also known as the difference between, or the spread between, the offer price and the price paid by the underwriter. Here is an example. You can see, assume the issuing company incurs $1 million in expense to sell 3 million shares at $40 each to an underwriter, and underwriter sells the shares at 43 each. What is the spread for this deal? So you can see that underwriter buy them at $40 each and resell them at $43 each. So $3 is the spread per share, and they're issuing 3 million shares. So total spread is 9 million. That means that's the amount goes to the underwriter for providing this underwriting services. Now, underwriting agreement. Underwriters provide underwriting services to the issuing company under different agreements. For example, one can be a firm commitment. In a firm commitment agreement, what they do is the underwriters took the risk that the issue might flop and they would be left with unwanted stocks. Okay, so in this case, the underwriter will buy all the shares from the issuing company and resell them to the investor. So if any of them remain unsold, the underwriter have to keep them. However, in another agreement which is known as best effort commitment, in a best effort commitment, the underwriters may be prepared to handle the sale only as a best effort basis. So in this case, the underwriter will promise to sell as much as the issue possible, but that do not guarantee that they sell the entire amount. And there are some flotation costs. Flotation costs basically indicates the all costs associated with this underwriting. That includes the administration fee and also the charges paid to underwriter. Look at an example here. How much will a firm receive in net funding from a firm commitment underwriting of 250,000 shares priced to the public at $40 per share if a 10% underwriting spread has been added to the price paid by the underwriter? Additionally, the firm pays 600,000 in legal fees. So you can see that cost to the public is $40, and that is embedded with 10% underwriting spread. So the issuer actually get $36.36, and the spread, you can see difference between these two is 3.64 per share. So how many shares are issued? 250,000 shares. The issuer get 36.36 per share. So this is the fund to the issuer, and there is also a legal fees which is 600,000 that is deducted. So the net fund to the issuer is 8,490,000. And the flotation cost that we were discussing in the last slide. So the flotation cost will include the amount goes to the underwriter, which is 3.63, and also the legal fees. Some of these is the flotation cost. Now, IPO underpricing. As I previously mentioned that typically when a company engages in IPO, the issue price or the offer price is lower, typically lower than what the fundamental value should be. And this is known as IPO underpricing. Now, you understand that this IPO underpricing can be costly since the offer price is less than the true value of the issued securities. Investor who bought the issue get a bargain at the expense of the firm's original shareholders. These costs of underpricing are hidden, nevertheless real. For IPOs, they generally exceed all other issue costs. Whenever any company goes public, it is very difficult to judge how much investors will be prepared to pay for their stocks. Sometimes the underwriters misjudge dramatically. For example, when the prospectus for the IPO of eBay was first published, the underwriters indicated that the company would sell 3.5 million shares at a price between $14 and $16 each. However, the enthusiasm for eBay's web-based auction system was such that the underwriters increased the issue price to 18. The next morning, dealers were flooded with the orders to buy eBay. Over 4.5 million shares traded, and the stock closed the day at a price of 47.435. Okay, so as I said, that underpricing can be costly to the company. Look at this example. Assume the issuer incurs 1 million in other expenses to sell 3 million shares at $40 each to an underwriter, and the underwriter sells the shares to $43 each. By the end of the first day trading, the issuing company's stock price had risen to $70. What is the total cost of underpricing? So you understand that the underwriter sells the shares at $43 each. So that's the price at which the share was sold to general investor. At the first day of trading, the share price risen to $70. So difference is the amount that was actually lost by the company. And 3 million shares, so $81 million was basically lost because the shares were underpriced. So that's the reason I say that underpricing can be pretty expensive to the company. Now, who are the underwriters? Look at few examples. These are some big underwriters in the world. For example, JP Morgan, Deutsche Bank, Citi, Barclays, Bank of America, Merrill Lynch, Goldman Sachs, Morgan Stanley, HSBC, Credit Suisse, and BNP Paribas. And do you have any idea like what's the size of the fund or the issue they underwrites? For example, this is the numbers for between January to June 2014. For example, JP Morgan alone have underwritten 1,120 issues, and the total value of the these underwriting issues was 271 billion. Deutsche Bank has underwritten 1,006 issues, and the value of these total underwriting issues was 239 billion. So these are some examples of the big underwriters. Now, as I talked about IPO underpricing, due to the reason of this underpricing, the initial return of IPO, the average initial return of IPO is typically pretty high. The initial return means if you buy shares at the offer price and sell the share immediately after the IPO, let's say in the first day the stocks starts trading, the return that you get is known as initial public offering, or the initial return on the public offering. Now, as the IPOs are underpriced, that means offer price is typically lower and the first day of price will be higher, so you have a chance that you earn a very high initial return. And these are the average initial return for different countries. You can see that sometimes it can be as high as more than 200%. So as an investor, you may tend to buy the shares from the IPO and try to sell it immediately after the IPO to get the advantage of these exceptionally high initial IPO returns. And these are the IPO proceeds over time between 1990 to 2013. And you can see this period, this is known as hot IPO market, when there were a huge IPOs came into the market. So these are the IPO proceeds. You can see that this period, it was average 65 billion, and IPO returns were also pretty much high. It's as high as 70% sometimes. However, just after the dot-com bubble, these IPO proceeds and return both declined, and it was the lowest during this period over the 1990 to 2013 at the height of the global financial crisis. However, after the crisis, you can see that IPO proceeds and the initial return both increased. Now, security sales by the public companies. So as we know that the companies can sell securities by different means. Now, you understand that a company's first public issue of a stock is seldom its last. As the firm grows, it is likely to make further issues of debt and equity. Public companies can issue securities either by offering them to investors at large or by making a right issue that is limited to existing stockholders. So in this video, we will be talking about general cash offers, and in the next video, we will be talking about the right issue. So what do we mean by general cash offer? When a corporation makes a general cash offer of debt or equity, it goes through much of the same procedure when it first went public. In other words, it registers the issue with the Securities and Exchange Commission and then sells the securities to underwriter or the syndicate of underwriter, who in turn offers the securities to the public. Before the price of the issue is fixed, the underwriter will build up a book of likely demand of the securities, just as in the case of typical IPOs, and this is known as book building. As far as the international security issue is concerned, you know, as I indicated earlier, instead of borrowing or raising funds from their local market, companies often issue securities in another country's domestic market, in which case the issue will be governed by the rules of that country. A second alternative is to make the issue of Eurobonds, which is underwritten by a group of international banks and offered simultaneously to investors in a number of countries. The borrower must provide a prospectus of offering circular that sets out the detailed terms of the issue. The underwriter will then build up a book of potential orders, and finally the issue will be priced and sold. Very large debt issue may be sold as global bonds, which is one part sold internationally in the Eurobond market and the remainder sold in the company's domestic markets. So, just to summarize, Eurobonds is the bond sold in different foreign countries, whereas global bond is the bond that is sold in the issuing company's domestic country as well as in the international market. Now, the typical underwriting spread for some big IPOs, you can see that so far the biggest IPO recorded was Alibaba Group, and the issue amount was 21,767 million, and in that case, underwriting fee was 1.2%. The next big one was Twitter, 1,820 million, and underwriting fee was 3.25%. And you can see that sometimes this underwriting fee can be as high as 7%. Those are for Billicom Pharmaceuticals, Spark Energy, and so on. And also sometimes it can be as low as 0.5%. Hilton Worldwide, which is in the case of seasoned offering. Seasoned offering is the subsequent offering of stocks by a company. That means initial public offering is the first time issuance of share to investor, whereas seasoned offering is the subsequent offerings. And these are the underwriting spread for the bond, and you can see that underwriting spread of the bonds is typically lower than the underwriting spread of the equities, because bond underwriting is typically less risky compared to underwriting equities. So these are the costs of raising capital, and you can see that these are the IPOs, convertibles, bonds, and state-owned organization. And as expected, the direct cost of raising capital is highest in the case of IPOs, whereas lowest in the case of bonds, as we have also seen in the case of underwriting fees in the last slide. So this is the end of our discussion on the IPO. In the next video, we will be talking about right issues. Thank you very much.